TV18 and you're watching CNBC TV18. This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Lata, Anuj and Sonia joining me from their respective homes. But before anything else, here's wishing Sonia a very, very happy birthday. She's one of those lucky ones who shares her birthday with her son. So happy birthday, Kabir, as well.
Thank you, Lata. Thank you so much. I know it's a tough time to celebrate birthdays because you can't have huge parties, etc. But it's a great day for me because it's very, very special. Thank you.
Of course, but you know what, Sonia, the whole market is partying, so it doesn't matter. You can join in. Well, we'll have to see whether they continue to party today because the markets have run very hard for the last 3-4 days. Usually you see this on the penultimate day. Wednesday is a clear uptrending day on several occasions. And then on for FNO day, you would have expiry day on Thursday, you would have some volatility. But now we've already run very hard. The FI numbers, which was 1,200 crore plus, became 400 crore plus, and yesterday it was it was 170 crore plus. So as you go higher and higher, the trickle, actually, the flow becomes a trickle. But we'll have to wait and see. The global tailwind is so very strong that it is now that we break 10,500. Anuj, would you say today is the day?
Good morning, Lata. Well, you know what? I thought that today could be perhaps a red day, but then, as you reminded, it's Sonia's birthday, so perhaps we should have some cheers. Sonia, happy birthday to you, and of course to Kabir. You're one of those rare people who on their birthday have someone more important's birthday. So first of all, I want to wish happy birthday to Sonia and Kabir, of course. Now let me come on the market. Let me come on the market now. We will of course have a chat with Sonia through the day. Look, Lata, the market's going through what I call a parabola kind of a move. In a parabola, it's the question always is how do you enter, because it's the problem would always be that it's too late to enter but too early to short sell. It's that kind of a market. These kind of moves enter really badly for those who enter quite late, but then you don't know what is quite late right now. Is this late, or would 11,200 be late? That is the question that you don't know. Now, purely from a technical point of view, we are now about to complete a 66% retracement of the overall fall of the market, which would be the important zone. The market struggled a bit at 50%. Now 66% becomes important. That level comes in at 10,750. Also, the 200-day moving average is 10,900. So I think it's possible that in this current expansion that the market has one large sharp move is pending towards the 200-day moving average of 10,900, which would correspond with a bank Nifty move towards it 24,000. Now that's purely on the technicals and the way the market set up as of now. But any entry in this market now has to be with the knowledge that you can get it horribly wrong, and that's why risk management is more important now than it has been for last 2 or 3 months. Also, the quality of mid-cap rally has deteriorated. You've been talking about FI momentum, that's been waning for last 2-3 days. The delivery percentages have been coming down in large caps. That's also something that you have to take note of. So there are caution signs, but it does not mean that the market stops going up, or it does not mean that you short the market. The market is still a buy on dips market, unless proven otherwise. And last 2 days left, it's been a really spectacular series. Who's to say that we won't have a great expiry as well? But let's see. We will see the first hour today, and then see if we have a Wednesday trending move or not. But over to you, Sonia, now.
Well, thanks, Anuj. Thanks for your wishes. And, I really miss those days when we used to celebrate an office with a treat and, everyone rejoicing together. But I guess those days will come back, definitely. But on to your point about the one last sharp move for traders, I take your point that, there's some caution now, because even if you look at the FI numbers, barely 169 crores have been bought in the cash market. DI has bought about 450 odd crores. And there was a lot of delivery buying in financials, so that continues. But Anuj, what does all of this mean for investors? Even if we do see a move towards the 200 DMA, will it get done at that, or do you think that this is a start of a structural up move in the market now, since most of the bad news seems to be behind us?
Sonia, for investors, frankly, beyond a point, it does not matter what kind of market you are in, because if you will make a good portfolio, that will do well even in bad markets. Or if you adjust your portfolio according to the market reality, you will still do well. A lot of stocks hit 52-week highs when the market made a 52-week low in March. So that is, I think, if your question is about a lot of these mid caps and small caps which have run up a lot, and if you have been lucky to get into some of these stocks where there's momentum, stocks are rallying 30-40%. I think in that case, it's perhaps now worthwhile to take a relook at your portfolio and say, okay, are these stocks going to be good? I mean, like you said, if the market is locked up for 10 years, would you be okay holding those stocks? If that is the case, then perhaps you keep holding on. So that's the call that investor has to take. And I think from the trader point of view, you have to respect the screen. As of now, the screen is not giving you any indication that this market is turning.
Fair point. That it is divorced from macros is not something that's hurting the market. By the way, we have been having delivered home food, pizzas, McDonald's and, Subways for some time now. So those who want to celebrate their parties can always do that. Birthday parties can be done with home delivered food. Sonia, I just want to tell you, I can mail my address to you if you wish. But anyway, that's for a later moment. For the moment, let me give you the equity call. It's an important one that's coming in from David Costin of Goldman Sachs. He says incremental net equity demand represents only a modest upside risk to share prices in the near term. Investors have re-risked since the trough, and some additional room exists for equity allocations to rise and cash allocations to decline until they reach pre-crisis levels. However, Goldman Sachs expects the potential risk of a second wave and the fast approaching US presidential election to limit a significant increase in equity exposures. Periods of elevated policy uncertainty have generally coincided with lower than average equity allocations during the past 30 years. They expect the S&P 500 will trade in a range of 2750 to 3200 for the rest of 2020. Year-end target remains 3000.
Okay, well, let's tell you about the money markets because the rupee strengthened yesterday to 75.64 versus the dollar. Pramit Brahmavat of Veracity says the rupee will continue its march ahead as foreign investors are pumping money and domestic equity markets are showing some strength. The trading range for the spot dollar INR pair is seen at 75.20 to 75.80 today.
And on bonds, Dhaval Dalal of Edelweiss says bond prices gave up some of their recent gains amid improving global economic outlook and risk on sentiment. Market participants positioning ahead of the Q2 supply and lack of RBI purchase from the secondary market also contributed to it. That said, bond outlook remains positive in the medium term. He expects the new 10-year benchmark bond yield to trade between 5.85 to 5.95 in the near term. But please do notice that bond was issued at 5.79. Yields have shot up. Those who are raising petrol prices have to remember that.
Okay, well, today at least the prices have not been changed. Thank God for that. But let's do one thing. Let's talk about the global cues. Here's Mangalam with the world view.
Well, the global markets continue to rise on hopes of recovery post-COVID and a lot of liquidity. So the Dow adding around 130 odd points yesterday as well. The Nasdaq has been on a funk of its own, 2 days of consecutive record closes. In fact, it's notched 8 straight sessions of gain, the first time it's done so in 2020. And yesterday's gains on the Dow as well as Nasdaq were led by a couple of stocks. Apple's at yet another record high after the company launched or announced the new operating systems for a variety of their products. And as a Apple product fan, I'm definitely looking forward to this. Visa and United Health also gained. But the risk of coronavirus definitely not off the table. Yesterday, we had Dr. Anthony Fauci saying that there has been a disturbing surge in new COVID-19 cases. However, he barred that statement by saying that maybe there will not be a requirement of an absolute shutdown, but the street will definitely be mindful of this. The European markets also gained in yesterday's trading session, and this was on account of some amelioration coming in with regards to the macroeconomic data. For June, the manufacturing index is still in contraction at 47.5, but it has improved a considerable bit from April and May levels of 13 and 31.9. The Asian markets, however, are keeping in mind what Dr. Anthony Fauci said, which is why we're seeing some give up from the gains, morning highs. The SGX Nifty indicates a softish start. So let's actually listen in to what Dr. Anthony Fauci had to say.
Now, while the deaths are going down, the concern is if those cases then infect people who wind up getting sick and go to the hospital, it is conceivable you may see the deaths going up. So I think it's too early to say because the deaths are going down.
Okay, all right. But let's get back to the big liquidity gush that we've seen in the market. Billionaire investor and co-founder of Oaktree Capital Management, Howard Marks, says that the Fed has injected a lot of liquidity to support the economy and the markets, and he does not expect a sharp V-shaped recovery for the markets anytime soon. Listen in.
People are taking the Fed's word for it. There's a saying, you can't fight the Fed. And most people have concluded that the Fed wants the market to be higher, and they'll do things that make it higher. They've done a lot of good things for the economy. They've put a lot of liquidity into the system. They've bid strongly for securities, all of which have the effect of lifting the markets. And by the way, they've indicated that they're going to keep doing so. If they get the market to a level where it wouldn't be but for their buying, then does that mean that the markets are dependent on Fed buying forever? And what happens if they stop? And will they ever stop? And can they keep doing it forever? It looks to me and many people like the markets are somewhat ahead of themselves. In the second quarter, we're going to have a collapse. And then the third quarter will be better. And the fourth quarter will be better than that. That's a V. But the real question is, when will we be back to the earnings and the GDP that we had in 2019 and that we were supposed to have had in 2020? And I would say that maybe we'll be back to the 19 levels in 21 and to the 20 levels in 22. So that's not a vibrant, vigorous V to me.
And so that's the problem, whether it's David Costin of Goldman Sachs, whose view we read out to you, or it's Howard Marks, marquee investors unable to make peace with the lack of earnings, but the shooting up of share prices because of the Fed and other central banks. So that's the dilemma annoying everyone. But that's what trading is all about. We have to navigate this. We're going to take a break on that note and come back with our entire team. There are lots of very important stocks to watch out because of their earnings. We are back in a minute.